Well, hello and welcome to the Center for Agricultural Profitability at the University of Nebraska-Lincoln and this week's webinar series. I'm Brad Lubin, an Extension Policy Specialist in the Agricultural Economics Department and the Center for Ag Profitability, and we invite you to look at our CAP website at cap.unl.edu to find a variety of and ranch management tools and resources, as well as information on this webinar and previous and upcoming webinars as well. This webinar today is actually a throwback to our very first webinar that we conducted in our webinar series here with the Center for Ag Profitability and the UNL extension work that came before. Nathan Kauffman is the branch executive, senior vice president at the Omaha branch executive with the Federal Reserve Bank of Kansas City. And Nathan was our first guest back in 2020 at the sort of the crux of the COVID pandemic and the economic shocks and challenges that we saw at the time. Well, 5 years later, we still are talking about economic issues, but this time it's economic conditions in agriculture and the continuing really sort of divergence between the livestock sector, particularly cattle, and the crop sector, which remains under substantial pressure with declining prices and cost pressures. Today, we get to look at that current economic and financial condition. We get to talk about trends in lending activity and financial position, and we get a broader outlook of the financial picture and for interest costs and financial management for the year ahead. So, as I said, we welcome Nathan Kauffman, Senior Vice President and Omaha Branch Executive with the Federal Reserve Bank of Kansas City at their Omaha branch office. Kansas City's Fed is really the nation's leading Fed branch focusing on agriculture, and Nathan is the Kansas City Fed's lead economist and representative in the ag arena and in the state of Nebraska. Nate provides strategic direction and oversight for the Omaha branch, regional research and economic outreach throughout the state and the region. He also now serves as executive director of the bank's new Center for Agriculture and the Economy, which provides timely analysis of industry developments and conducts ongoing research in the ag economy. Nathan, with all that said, welcome and thank you for joining us today. Look forward to your presentation. A reminder to those participating, if you have any questions, please post them in the Q&A section of Zoom. If you don't see Q&A as one of the button choices, look for the ellipses, the three dots to find more choices. Look for the Q&A tab and ask your questions there, and we'll look forward to a discussion of those questions and answers to follow. So, Nathan, thank you again for joining us.
Well, thanks, Brad. Thanks for the invitation. It's good to be back. I don't know that I had realized that it's already been 6 years since that first one, but I'm at least glad that the circumstances are not the same as it was for those 6 years ago. As Brad mentioned, I'm with the Federal Reserve Bank of Kansas City. I'm based in the Omaha branch office. And just very briefly, I know many people listening here are probably familiar, but for those that aren't, the Federal Reserve Bank of Kansas City is our head office. We have a branch in Omaha, Denver, and Oklahoma City. So the coverage for us is 7 states in the middle of the country. We're part of the nation's central bank, with the Board of Governors being the government side of that entity and the 12 regional reserve banks being the private side. So one of the areas that we're responsible for is providing support for monetary policy, and that's economic developments to inform a broader national conversation. And of course, agriculture is always a part of that. For us at the Kansas City Fed, ag is a disproportionately large industry, both in terms of production, but when you think about other industries that connect to agriculture, and also financial institutions that have a connection to ag as well. So that's a little bit more of the background and both the Fed and the focus. I've been with the Fed for, we were talking about this before, about 14 years, and have an economics background with a focus in agriculture. The Kansas City Fed, as Brad mentioned, has had a longstanding focus in ag. And I will just mention before going into the presentation, to elaborate just for a minute, we launched last fall what we're calling for, and you see on this first slide, a Center for Agriculture and the Economy. And in a nutshell, the purpose of this center is to serve as a link between agriculture and the Fed. We've been doing some amount of that work for a long time, but really this is an attempt to position the Kansas City Fed in that way and make sure that the voice and views from the ag sector and regions that would have a concentration in agriculture would have that those views would be ultimately shared in this broader national discussion. So with that, I'll go ahead and get started. And this is intended to be an economic update, as the title suggests. There's a couple of things that it is and isn't. One is it's titled the U.S. Economic Update, Agricultural Economic Update. Most of my focus will be on industries that would be of most significance in the Midwest and some specific to Nebraska. So it's not necessarily going to attempt to try to explain what's happening everywhere in segments of agriculture, but primarily those that are most prominent in this region. I also don't have a lot of information in this presentation on some of the broader developments in the U.S. economy. This is intended to be ag specific. I'm glad to take any of those as questions. I do think that some of those developments are extremely relevant for ultimately the prospects for agriculture, with it being a global market. What's happening with respect to broader economic growth and inflation and things along those lines are going to be important too. So I'm glad to take questions on that, but the focus for this afternoon will be primarily on aspects pertaining to agriculture. So with that as a starting point, I will move forward here. And just to get us started at a very high level, on the surface of it, economic conditions in agriculture generally appeared strong in 2025, and I'm trying to be careful with words here. But there's been some notable disparities in risks, and Brad alluded to some of this at the outset and in the description of really some diversion between prospects in livestock and in the crop industry, and that's been ongoing for some time. USDA released its first approximation for what it's expecting to see in farm income for 2026 about a week ago. And this is shown in the chart on the left-hand side. And there were a lot of moving pieces to that report, and I want to try to distill it into just, again, a higher level. On the surface of it, income still looks strong. And the reason I say that is because of what you see there is the 20-year average. Income in both 2025 and 2026 is well above that level. Now, there's some important caveats to that, and I'll go through that as we get a little bit further. The first caveat is that it's obviously well off of where we had been a couple of years ago. So despite the strength or relative strength, it's still an adjustment. The other nuance is what you see in the red shaded region of the chart here, which is to indicate that government payments, again, are accounting for a large portion of net farm income, that absent those government payments, the picture would look bleaker for sure. And then the third nuance here, and I'll get into this in the next couple of slides, is that there is, as I mentioned, some significant unevenness between the livestock industry and primarily cattle in this region and the crop industry, and that'll become apparent. So the chart on the right-hand side is breaking down some of this divergence that becomes obvious in terms of this unevenness between crops and livestock, where the blue line is showing just a very broad measure of crop prices. And this does take into account the broad set of commodity prices that you would see at a national level, not just corn and soybeans. And then the red line showing livestock prices. I'll show it on the next slide. That this is actually understating the strength in cattle. Some of the decline that you're seeing here is due to things like milk prices and hogs. So it's not necessarily coming from any significant declines in cattle just yet. The primary point to make, though, on this chart here on this slide is really the green line in combination with both of the other two lines, which is to say that expenses have still been elevated. We haven't seen much retracement in expenses. We're not seeing the same pace of growth, of course, in expenses that we saw during the pandemic and in the 2 years that followed. But at the same time, you can see just in comparing the green line and the blue line that expenses are remaining elevated while prices are obviously much lower. So drilling into this just a little bit further, and I'll keep it at a relatively high level as it relates to the fundamentals of the ag economy, and I actually want to spend most of my time here today talking about what we're seeing with respect to financial conditions. This is a chart that just breaks down commodity prices by specific commodity, and it's organized from left to right based on those commodities that are best performing thus far in 2026 relative to 2019 and those that are generally worst performing here most recently. And it's maybe not surprising that soybeans, wheat, and corn are on the further right side of this chart and cattle on the far left, suggesting that prices continue to rise. It's important here to note that, and there's a mislabel here, the index is 2019, but it's not 100, it's at 0. So the best way to interpret this is essentially a 100% increase in cattle prices relative to 2019. It is worth one brief comment here on dairy because the far right here, and we don't have a lot of dairy necessarily. There's some in our region in the Kansas City Fed, but it's worth a comment because this chart would suggest that there's maybe more pressure than what there actually is. And it's actually because of the strength and what you see on the left-hand side of this chart with cattle, that the dairy industry is actually doing much better than what this might show. And that's because of the relevance of beef on dairy. So with everything in the cattle market and in beef, that has created pretty significant opportunities for dairy producers that would really have been absent several years ago. So this chart is just to suggest us, and again, paying specific attention to corn and soybeans for a moment, to suggest that there's not been a lot of price changes over the last 3 years. They've been pretty flat since 2024, still higher than what they were in 2019, but once again, have to keep in mind that expenses are quite a bit higher than what they were in 2019 when we look at commodity prices. So let me spend just 1 minute here on the cattle market before going into some of the crop sector, and then I'll switch over to finances. This is a narrative, as you see in the top of this slide, that has been, I think, the case for quite some time, that low inventories have been supporting prices and ultimately putting producers or operations into a position where they have substantial opportunity to sell for a profit. I'll have some caveats to this slide in just a moment, but before getting there, the chart on the left is really just to indicate the degree to which we're seeing profitability in this industry. The blue bars represent essentially your average break-even cost, and this is at a national level, so it's not probably representative for any specific region, but on average. And then the blue box that you see above those would be the price range during the course of the year. So in 2025, for example, that price range between $2,000 $2,800 per cow, you're looking at something in the vicinity of twice the level of production costs. And the orange dot representing futures prices would suggest that there's still substantial profit opportunity. Now, one caveat to this chart is you might ask the question, and especially as you look at the chart on the right-hand side and see that inventories have been declining for some time, that this market would be suggesting that there should be some expansion happening and there should be some herd rebuilding. And the reality is that has been pretty slow. And part of the reason is because, well, there are still costs involved, but these costs really have to be taken into account for multiple years and not just the current environment. I think there's some hesitation and some amount of risk aversion, just given the current level of prices, to think about expanding or investing in this market, whether you're the operation or the lender. There is some risk involved, and so just given the level of prices and essentially the point at which you would be investing in this market. So the herd rebuilding has been relatively slow. It's happening in some places, but it's been pretty slow, and that's clear, I think, in the chart on the right-hand side that shows the inventory, which again, this is only shown back to 2010, but if you went back further, it would show a longer term decline. Now, it is important to keep in mind that it's not just I think this point sometimes gets missed, but it's not just the number of animals. You obviously have to be thinking about what it means in terms of beef production. And beef production has been declining, but overall, that level has been higher than what the inventories would otherwise suggest. And this is just because the animals are generally heavier than they were years and years ago. And so the production that we get from beef is not quite as, it hasn't declined quite as much as what the inventories might suggest. Nevertheless, this slide is intended to show that profit margins in the cattle industry have remained very strong as we start the year in 2026. Switching to the supply and demand picture for crops, you'll see that it becomes substantially less optimistic in terms of what we see by way of supply and global demand. The chart on the left is stocks to use ratios for corn, soybeans, and wheat. And this is really the best measure of, I think, of something that captures just at a very high level the overall level of demand alongside supply. So as this number increases, obviously you're increasing supplies. That's the stocks number relative to the use. And for all three of these commodities in the US, and particularly corn here, from the last harvest, showing some significant increases in stocks relative to use. We know that this isn't just a US story, though, and so some of a significant part of the price pressure over the years, but particularly the past few years in these markets has been coming from global crop production. So the chart on the right showing that essentially if you're to compare 2025 with 2010, you're looking at about a 50% increase over the course of those 15 years in global production of corn. So yes, we've seen increases in global demand for commodities, but it's ultimately the intersection of these two, both supply and demand, that's been resulting in the price environment that we've seen here for the past couple of years. So I have one chart to illustrate in a similar manner on crops as I had on cattle, which goes to the point that was made earlier about the unevenness. And this chart or this slide is similar in scope, just shown quite a little bit differently. The chart on the left is corn and soybeans and profits in those markets, and on the right for wheat. The lines here represent production costs, and the gray shaded regions that you see would represent the price ranges that producers would potentially be able to sell at during any time during the calendar year. So those years, for example, between 2020 and really 2023, were very good. And even if you got the bottom of the market in any of those years, it was still at a profit. You can see the gray shaded region the last 2 or 3 years has been below the cost of production. Again, these are national averages, so take that for what it's worth. And then the blue dot represents March futures prices, which is to say that even if you were to lock in something on the board now, it's at a price that is less than production costs. Similarly for wheat, though not quite as optimistic during those years from 2020 to 2023, there was a price spike, obviously, during the portion of 2022 with the invasion of Ukraine. But following that, it's been a market that's been under pressure, and this is actually pretty similar to and familiar, I think, for producers in this market when you compare this with the pre-pandemic years. So once again, on this chart for this slide, profit opportunities have generally remained pretty narrow. Ad hoc payments and the bridge payments in particular will provide some amount of support. Crop insurance will provide some support. But I think that the bigger concern is, especially as you think about the end of 2026, it's what these prices might look like as we're going into 2027. Those payments are likely to be temporary. They'll offset, I think, some of the losses, but those aren't necessarily changing the fundamental structure of supply and demand in the markets. And at some point, you would expect that pressure to resurface. So switching gears now, I want to spend the remainder of the time talking about the financial implications for what we're seeing. And a lot of this probably won't be surprising. We talked about the unevenness and the opportunities in the cattle market leading to some strength there with pressure in the crop industry. And what you tend to see then with this is, first of all, there's been a lot of negative sentiment around ag, specifically because of the crop industry. And so what I want to spend some time on is just talking through how this has shown up in financials, and I'll try to do it a little bit sequentially. So the first thing that has happened, as you see on this slide in the purple line, is that operating expenses have remained quite high. So you can see here relative to 2019, you're up about 20 points on this chart. And this is from some surveys that we collect that just show general trends in these numbers. So operating expenses remaining elevated as costs are high. And the next step of that would suggest then that operating loans have also surged, and that's shown in the light blue line. So with expenses high, commodity prices down, specifically for crops, you see that there's been more demand for operating loans. And then the next piece of that, thinking through the next sequence, is that the debt service ratio, or you could look at other numbers, metrics of this, to see that the capacity that producers or borrowers have to repay loans is not what it was a couple of years ago. Now, I want to just real quick on this point, it's not as bad as what it might suggest. And the reason I think that you're seeing this is because of a couple of things. First is the really good years from 2021 through 2023. There was a significant amount of working capital build during those years. There have been government payments over the years, I think, that have mitigated some of the losses. So even though you're seeing this pretty significant increase in operating loans, and as I mentioned in the previous chart, negative profit margins, and this is the message I'll try hard to deliver. It's not leading to what we would call as a crisis or something where you're seeing significant deterioration in credit quality. It's gradual, and there's a certain percentage of each lender's portfolio where they're showing some stress. And I think as all of you interact with people that you know in the industry, you'll hear some similar narratives. There are some producers who are still doing okay, and there's others that are facing a lot of stress. And it's just thinking about what the combination of this looks like. So a couple of pictures to demonstrate this uneven description where the stress has been building, it's been building gradually, but when you look at aggregate numbers, it's not yet going to suggest that there is substantial stress. The chart on the left here on this slide shows delinquency rates from commercial banks. And you can see that there is a small increase over the past couple of years, but still pretty minor and doesn't really even compare with the level that we had seen in the 4 or 5 years before the pandemic. Now, there's a point about this chart itself, and there's limitations to the signal that we might get from looking at delinquency rates, and that is that delinquency rates are usually pretty backward looking. It's in both the interest of the lender and the borrower to avoid a loan going into default. So steps are, to the extent that they can be taken, to avoid a loan becoming delinquent. That just because that loan is not going into delinquency doesn't mean then that there's not financial stress. So I don't want to suggest that the delinquency rates don't matter, but they're not necessarily the best forward-looking measure of financial stress. It gives a good snapshot of what the industry looks like. The chart on the right-hand side, I think, shows where it shows more of the concern where some things have evolved, and that is to say, and these numbers do come from our survey of credit conditions. So we ask questions on a quarterly basis of commercial banks, and we ask those banks to respond to things like the pace of loan repayment or capital spending, renewals and extension. And you're going to see a pretty familiar theme here. Loan demand has picked up over the past couple of years, as have renewals and extensions, as you see in the green line. So borrowers are needing more in the way of financing, not just in terms of new financing, but even rolling over debt from one year to the next and not paying that debt down to the same degree. Loan repayment rates, as shown in the blue, have deteriorated pretty substantially, and that's coming off of a level that had been quite high just following the pandemic. You're actually starting to see some similarities to where we had been just prior to the pandemic, and that may be a familiar refrain here as we look at the rest of the financial information. The other thing to keep in mind here is that household expenses have still also remained elevated. I'm not spending a lot of time talking about the general economy, but this is a story of inflation that whether you're in ag or not in ag, those costs have also remained high. And then one of the levers that producers have to pull when they're thinking about how to reconcile an otherwise tight profit margin environment is to cut back on capital spending. And so we have definitely seen some sharper declines in capital spending as shown in the orange line here. The unevenness that I mentioned earlier shows up in our survey when we ask commercial banks to respond to things like repayment rates and income, and I'm just showing income to make the point here on this chart. And this is essentially lenders responding to a question about whether their borrowers are showing higher or lower income relative to a year before. And the unevenness that shows up is in our region, a difference between a state like Nebraska and a state like Oklahoma. We do have a lot of our community banks in Nebraska would have some exposure to the crop industry. And so that's showing up as sharply negative in contrast to a state like Oklahoma, where it's disproportionately more focused on the cattle industry or livestock in general. So that's been a familiar trend the last couple of years, where those regions and other businesses that are tied into cattle and livestock have continued to show strength, while those connected to crops have not. Um, Trying to again put this into context in terms of what the challenge and the gradual increase in financial stress means in aggregate. I don't want to diminish the increase in financial stress because we're seeing it, and I've talked about that already. But at the same time, there are some metrics that we would see and look at that would suggest that the industry in aggregate is actually still in a pretty stable position. That's not necessarily the picture of what you might hear elsewhere, either reported in the media, or it's not even a picture of what's of the totality of the industry. It's just suggesting that this is the aggregate picture. So land values matter a lot for the financial health of agriculture for two reasons. The first is that land is by far the largest asset of producers. Now, this is going to be different for producers that don't own land, and I'll touch on that in a minute. But the first reason is because of just the level of assets that farmland commands. And then the second reason is that for the sake of financing, lenders will, of course, use collateral as they're evaluating the creditworthiness of their borrowers. And so to the extent that land values remain strong and those producers that have equity built up in land, that ensures some amount of smooth continuity as it relates to financing at a time when demand for financing has been elevated. So a couple of things to look at then as it relates to the land market. And the chart on the left is showing different numbers, one from Nebraska, one from the US, which is based on USDA data, and then the blue line are surveys, all of which show a very similar trend. Definitely more increases in a state like Nebraska that's been concentrated in the kinds of commodities that saw the run up between 20 and 2023. But the main point on this slide is just to note that even through the end of 2025, we really have not seen any aggregate declines in land values. Now, just to be clear, that's not to say we haven't seen any declines in land values. There are places, or there are potentially auctions or other things that show up where there's not the same kind of demand, or a price that's not at the level that might have been expected. But again, in aggregate, land values have still been high. Uh, we just released our fourth quarter survey of land and of credit conditions, and land values would show that they were pretty much even from the year before. So despite the pressure, it's just not showing up in land values just yet, which means then that it's really not showing up in cash rents either. And that's actually a headwind, obviously, for producers that are renting ground, but is another indicator of just something representing the overall financial health. Now, the caveats that I wanted to make to this slide are to suggest that there, of course, is a type of producer or operation that is facing more financial stress, and it would be that operation that generally it's a younger producer that hasn't been around long enough to take advantage of the really strong increases in land values. Maybe they're renting a disproportionately large share of their ground, and potentially even leveraged a bit more on things like machinery. Those operations are showing more financial stress. But for the operation that might own some land free and clear, and they've been cautious on maintaining working capital and keeping break-even costs down, there's quite a bit of wherewithal to withstand some of the pressure that we've seen. So just one more slide here on land values, because this is, I think, an important market to continue to track. If we were to see substantial declines in land values, that would have a different kind of implication. And I think that it is fair to say that there's been some amount of pullback in the purchase of farmland by farmers. This is also something that we track through our survey. And as you see in the blue line, it has come off a little bit in terms of the share that's ultimately purchased by farmers. It's come down from about 80% here during the post-pandemic years to something closer to 70 or 72%. But still to suggest, at least in our region, that the vast majority of land sales are being those are farmers that are buying that farmland. Volume has also been relatively stable, so we haven't necessarily seen that move too far one direction or another in terms of just the volume of sales. What you would worry about potentially here is if for whatever reason there was a large increase in the volume of sales at a time when profit margins aren't very strong, and whether or not the demand then for that land that goes onto the market would be sufficient to hold prices at to hold land prices at the level that they're at. So a couple more slides to elaborate on this point of really a couple different themes that emerge in terms of the financial picture. One is that at a snapshot level, things are still pretty stable, but the stress is building. It's just building gradually. Um, Once again, there are producers that are in more significant financial stress, and there are producers that are really very, very stable. When we talk to most of our lenders, and when we look at some of our own data, there's typically about 10 to 15% of a portfolio that is showing notable financial stress. But that means that there's essentially an 80 to 85% or somewhere thereabouts that is still showing a pretty strong financial position based on where things are right now. That's not to suggest it can't get worse, but that there has been a wherewithal to support that. The chart on the left on this slide and the slide in general is intended to show that debt has been building, but that leverage is still, I would say, relatively modest. It's been increasing, but it's modest. And this is because of support coming from land values. The chart on the left is broken down by both real estate and non-real estate. So you can see that even in inflation adjusted terms, it's well in advance of where we had been as it relates to debt prior to the 1980s. And this has actually been a fairly steady trend higher. Uh, that chart, I will say, it's not immediately clear that more debt is always a concern. Obviously, if there are opportunities to invest in agriculture, especially given just the price of the livestock and of cattle right now in the livestock industry, this would suggest that it's not necessarily all risk that shows up as an increase in debt. The measure of risk would be the chart on the right-hand side, and this is best thought of as a measure of solvency, where you'd be looking at your assets relative to debt and putting this in a debt to asset ratio. Of course, it's higher than what it had been several years ago, but still not nearly to the extent of what it would have been either in the 80s or really even in the late 1990s. So once again, this is support that's coming from land values in general, that despite the increase in debt, it's keeping those measures of solvency in check. Switching gears to talk just briefly about interest rates, because this has been something that has I think been sensitive over the last few years, especially with the rapid increase in rates from 2022 to 2023. So that being a more significant headwind, probably in 2024 and 2025 for producers that were seeing an increased need for financing at a time when interest rates were also much higher than what they had been. There's been some decline in rates as the Fed has pulled back on, as you see in the blue line, pulled back on short-term interest rates. And that's provided some amount of relief for rates on farm loans, as you see in the right-hand side, about 150 or 200 basis points less than what they would have been at the peak. But it is worth noting that what we've really seen is a decline in short-term interest rates, but some of the longer-term interest rates that might be more relevant for things like farmland actually haven't moved a lot. So if you look back at the chart on the left, that 10-year Treasury is still showing something that it's basically where it has been for the past few years, right around that 4% mark. So I want to end with this slide before going into questions, just to try to further elaborate on this idea that land values have shown the strength that they have, but to think about it from an investor perspective. You're ultimately looking for a return. So let's say that you own land and you are renting it out somewhere, and you're looking for some amount of cash return on that land that you're renting. Now, this isn't necessarily the picture for owner operators or others that are in farming and looking at negative margins. But when you think about what drives the potential for land values, we really need to think about it in the context of land being an investment. And those investment dollars could potentially be spent on something else. It doesn't have to be spent on land. So what we often refer to this as it's a capitalization rate. So this is essentially the amount of income that's generated relative to the price or the valuation of that asset. You can see in the case of farmland, which is the purple line, about 15 years ago, it was about 5%, and it's drifted to be just under 3% now. So once again, you can think about this as essentially a rate of return that owners are getting, or investors in land are getting just a touch under 3%. Now, you might ask, well, why would an investor want to invest in farmland if they could invest in a 10-year treasury and get something that's 4%, as I showed on the previous slide? Because the 10-year treasury is essentially a risk-free asset, and you could have 1 percentage point of return that's greater than what you would get as the cap rate on farmland. There was some thought several years ago that eventually, if interest rates would rise fast enough, that this increase in the 10-year treasury, once it passed that of the return on farmland, it would start to weigh on farmland valuations even more. At least one potential scenario and explanation as to maybe why it hasn't is that it could have to do with inflation. It's possible that investors do see land and other assets, not just land, but land as an investment to serve as a potential protection against inflation. And so when you look at not just the 10-year treasury, but look at the 10-year treasury of inflation protected securities. So this is essentially a yield that changes over time on the basis of inflation. And so you would expect that that return has to be lower really by whatever inflation is relative to the 10-year. And we haven't actually seen the cap rate on land values get to that point yet, which would suggest that if really what you're interested in is some sort of investment in a hard asset that generates a return and serves as some amount of shield from inflation, then it's still at least slightly attractive relative to that 10-year treasury that's in inflation protected securities. So just one possibility. It's certainly not the only reason that investors or producers invest in farmland. There's lots of other reasons, but thinking about it just as an investment can maybe offer some insight into why, even with increases in interest rates, we haven't yet seen a dramatic pullback. So I'm gonna wrap up just with a couple of quick comments, and then Brad, I'm glad to take questions that there are. Uh, Based on the information that we have so far, my best guess would be that profit margins for crop producers probably still remain narrow in 2026. The bridge payments that are set to go out here early in the year will provide some amount of support. But as I said, it's not necessarily going to change the fundamental supply and demand picture. It actually could even lead to more supply than what we might otherwise have expected to see. And that would result in even more pressure in prices later on. So once again, though, the strength of recent years has provided support, as have land values. Livestock operations, it's a different story. And for those that have cattle and available to sell them, it's been very strong. But as I mentioned earlier, herd rebuilding has been slow, and I think there's a number that would like to expand, but there's a certain amount of caution there, just given the level of prices. The way I would characterize financial stress is that it has increased slightly. And the reason I only say slightly is because I'm talking about the aggregate. I'm not talking about the 10 to 15% that are facing some significant financial pressure, but taking into account the fact that there are many producers that own land without debt, and their ability to potentially liquidate an asset if they needed to shore up working capital can't be understated. I think that, or can't be overstated. I think that there's substantial ability, even for that 10 to 15% that might be facing some pressure, that if they needed to liquidate assets to maintain some working capital. So we're not at a point where we've seen a lot of forced asset liquidation. And this is really why I'm saying that I think financial stress has increased, but only slightly in aggregate. And then lastly, reduced borrowing costs for operating loans. It's eased some pressure as the Fed has cut rates over the past couple of years. But once again, still seeing a picture that would show that demand for financing has been rising in recent months. So with that, I'm going to stop. The last slide here is just intended to be a QR code and a reference to our website for the Center for Ag and the Economy. This is where we would post all of our material that has a connection to agriculture and rural parts of our region. But with that, Brad, I'll turn it back to you, and we can take questions.
There we go, Nathan. I was afraid my computer was freezing up just in time for me to try and rejoin here. But I want to start with a general question and maybe more a clarification. Can the way I heard you describe the concerns about financial stress, and particularly with the downward uh, movement in the crop sector relative to livestock, but the concerns about financial stress versus overall financial strength. Uh, there are signs of stress. There are certainly operations that are facing stress, and yet the sector as a whole still looks like a very strong balance sheet. How do you delineate uh, the word stress versus strength here, and what's good to remember in the midst of this current outlook?
I think the main thing is that as long as there's some amount of, whether we want to call it strength or stability, that will be important um, for thinking that we're not necessarily in an environment that's going to lead to a spiral with what we would worry about is something that would precipitate large declines in land values, just as an example, and those that remember the 1980s and how that transitioned, that was the major concern there. And because in aggregate, the sector still looks fairly strong, I don't think that we would expect that as something that's likely to happen. So that's the way I think to best understand the description of it of the sector still being strong or stable, alongside also recognizing and validating that there are places where profit margins have been negative. It's maybe a concern from one year to the next of whether or not that operation is still viable. They're facing challenges with financing and even just finding a lender in terms of what can meet their needs. So it's not to downplay the risks and the concerns in the industry, but I think has to be taken into context alongside the overall picture. Now, what that ultimately points to is the potential for some amount of consolidation. If you were to envision 10 to 15% of, let's just say, for example, 10 to 15% of corn and soybean producers in this region are facing significant stress, then it might be the case that they do get to a point where they have to start liquidating some assets or potentially even envision a sale. And we have seen some bankruptcy numbers increase. So that would be something then that would lead toward more consolidation because generally those operations that have been in the strongest position to take on additional land have been those that are already relatively large. So that would be a trend that in my approximation is likely to continue.
Thanks, Nathan, for that. And so financially, one might imagine a management scenario is if current cash flow concerns are the primary problem and burning through working capital, then the question is how to potentially term out some of that debt, how to utilize the long run strength in the balance sheet. Is that kind of activity happening with extending operating notes and terming out some short run debt or some current debt? What do we see evidence of that happening already?
Yeah, there has been some of that. And, as we look at some of the other data that we have, the maturities on loans have also increased a bit. One of the other categories that we pay attention to is carryover debt. And we started to see this increase last year more substantially. And, we're still waiting the data for the first quarter of this year. But this would essentially be debt that hasn't been entirely paid down, but can potentially be restructured and shows up as carryover debt. It's going to be interesting to see the extent to which that continues again this year versus, to your point, the question about potentially terming out some debt and just looking at the overall risk profile of those borrowers because the concern is that carryover debt might work for a year or two, and you can find some ways to restructure things. But going into a third year, it starts to get a little bit more challenging with that. With the bridge payments and I think with some amount of increase lately in corn and soybean prices, I think you have seen producers inclined to pay down some of that debt a little bit more to put themselves in a little bit more manageable position. And then the last thing, Brad, I would say to that is, again, I didn't show any information specific to the broader U.S. economy, but We got new data out yesterday on the jobs market, and the unemployment rate went down a little bit again, and we're still in the low 4% as it relates to unemployment, which means that the job market has still been relatively healthy. It's maybe not as strong as it had been, but if it means that there needs to be a job to or some source of income to try to offset some of the weakness right now in ag, there are at least some of those opportunities.
But, Nathan, another continuation of that discussion about the health of the balance sheet, particularly, it's in part because of the continued health or strength in farmland values. Uh, that's something that, yes, if you look back at previous financial challenges in agriculture, uh, the the cycle is a function of if and when farmland values will start to show some struggle. Now, you described some of the reality that maybe farmland still looks like a very strong investment as part of a financial portfolio, as part of an inflation hedge. Uh, Perhaps farmland values are less tied to current ag income potential than they used to be. I'm not ready to study that equation, but is there some rationale that says we're banking on the strength of the balance sheet, but the balance sheet is fundamentally about farmland, and now we're concerned about farmland values. Maybe we're not that concerned yet at this point, right?
Yeah, it's worth remembering there, Brad, and we've talked about this I think before, but it's not just land values and thinking about ag. You could look at housing prices, or you could look at the stock market, or any other number of places where asset values have been increasing quite a bit. And so for a certain segment of the population that has benefited substantially from the appreciation of those assets, puts those individuals or households, businesses in a place where they can potentially afford to take on even a little bit more. Now, what that tends to lead to is we've talked about this in more general terms when it comes to the state of the general economy, is something that's evolving as what people will often refer to as a K-shaped economy. So you have one segment of a population or one segment of an industry, whatever that is showing still a lot of strength. And you have another segment that's not, and hence the shape of the letter K. And that really comes down to who owns the assets and who doesn't. And so in the case of agriculture, you could easily envision an environment where that K shape looks like those that have owned the assets and have benefited from that appreciation versus those that either don't own the assets, or now the price is at a level that it's not attainable. This has been around for a long time with young producers looking to get started. So I think that is something that we see show up, and I think worth at least recognizing that the overall level of assets in general, not just in ag, is something that's probably holding that market up. To your point, it's not just entirely about profit margins, but has to come from the totality of other resources available to buy farmland.
You bet. And and again, a little bit further point on the crop sector, maybe specifically as an example, uh, there are different fates between what seems to be the livestock sector and the crop sector, but even amongst the crop sector, those of some high equity established producers versus those with more high leverage or aggressive growth and borrowing on the balance sheet, the the cash flow needs, the economic break-evens, or the decision points, what price of corn might put a leverage borrower into trouble is still quite substantial for a high equity producer who is still generating cash on that operation. So there's a question specifically from the audience about advice for farmers and ranchers just entering the business. So it's often that beginning borrower that is not very asset rich, often more highly leveraged, challenged with perhaps economies of scale. What kind of advice do you give that beginner, whether it's the livestock sector, the cattle producer, or the row crop sector? What kind of advice do you have to help that beginning farmer rancher get in and maintain a good financial position?
Yeah, so there's obviously programs intended to try to provide some amount of support for young and beginning farmers, both national and state level, and other types of programs around that. We've heard a lot of anecdotes about the potential to diversify some operations and maintaining some amount of small scale type of endeavor within on your farm is one way to do that. So, whether it's a hog barn or whether it's thinking about how to be connected to the poultry industry or something along those lines. I think that you've seen some amount of effort at trying to diversify, to have some of that diversification. The other comment I guess I would have though is that agriculture has really changed over the past 30 or 40 years, and this is probably a statement of the obvious, but it used to be the case that on the farm, a farmer, to be in agriculture and to be a farmer, you were doing all of the things. You were doing all of the planting alongside, all of your own marketing and services and transportation and other things. And that the industry has shifted. It's gotten more specialized over the years. And so there are enterprises now that, of course, are doing some of those things. So the standard way of thinking about how to get involved in agriculture might not necessarily be the same as what it was back then, where the idea was the only way I can get involved in agriculture is by owning my own farm. And we all know, just given the level of prices right now, to buy into the market where it is right now is really difficult. But I say that just because it's not a way to, there's still ways of being involved in agriculture or even gaining some amount of experience and exposure to the industry. But it might look different than it did 20 or 30 years ago, and especially just given the price of land as a specific example.
You bet. Nathan, I have a quick fire round here to put your outlook hat on. I don't know how broad your outlook expertise is, but we'll start with the one that's in your home base. Um, what, to the extent you can say something, what can you say about the outlook for interest rates?
So what I can't give any kind of projection on where interest rates might
I
go. But what I
understand that.
would say is, what you will often hear Fed officials say is that it's going to come down to the balance of risks between the labor market and inflation. And inflation is still relatively high. It's above the Fed's target of 2%. And the labor market has shown some amount of softening, but there too, with an unemployment rate in the low fours, that I think still reflects a pretty strong labor market overall. And yesterday's jobs report that was much stronger than expected. I think that you could look at that and say that the economy is still performing relatively well. There's been a lot of momentum, and that the level of interest rates may not be all that restrictive in terms of restricting economic activity. And once again, keeping in mind that inflation is above that target of 2%.
You bet. And related to that, what does that mean for the balance of interest rates on short-term versus long-term debt?
So that is an important question. I'm glad you asked that one, because what the Federal Reserve has control over by way of its policy action is short-term interest rates. Now, without getting into the weeds of it, the Fed has other securities, and we have a balance sheet that affects longer-term interest rates as well. But what moves those longer-term interest rates actually has less to do with the Fed and more to do with other things. This is why you haven't seen the same kind of decline in something like a 10-year Treasury or even a mortgage rate as you have in those short-term interest rates that the Fed controls. And once again, that has to do with investors' appetite for those particular securities. And if it's a 10-year Treasury, there may be other assets that others are pursuing that's not necessarily the Treasury market for long-term assets as it has been in the past. So I do think what that means is we've seen a steeper yield curve. So you have some amount of decline in short-term interest rates while long-term interest rates remain relatively steady. And that has different implications for different players in the market. But for those that look at longer-term interest rates as the driver to ultimately the borrowing costs, there just hasn't been as much relief on that side, but for a variety of reasons outside the Fed.
Okay. So I'm going to ask you to put on both your cowboy hat and your farm cap here.
Okay.
The question is about the cattle herd. The economics suggest it's a great time to be in the business, but we also see really, really limited signs of growth, of moving into the expansion phase. Do you have insights on, or what perspectives do you have on sort of the structural challenges of watching the cattle herd move into the growth cycle?
Yeah, I mean, I think that there's a couple of structural challenges that in cattle different than some of the other markets. The first is thinking about automation. an industry like the poultry industry has been easier to automate over the years than what it has in cattle. The animals are just more unpredictable in terms of size. They need more space. It's a harder processing environment to automate relative to something like poultry. The importance of that then means that in terms of processing, which has its own issues around labor availability, costs have been higher. So that's one structural factor, I think, as it relates to cattle relative to other things. Another is just water, and this is connected to costs, but you're going to find that remaining there are certain costs to maintaining an operation relative to some of the others that matters over the long term. I do think that labor is a more significant challenge in that industry, especially as it relates to processing relative to some others. So those are probably a couple of thoughts. I think that demand has actually held up pretty well. So I don't necessarily see that as being the primary. I mean, and that's reflected in the fact that you have prices the level that they are. And it's hard work too. I mean, that has to be, I think, recognized as well that there are some things I think that are limiting the expansion, and part of it's the price, but part of it is just the cost structure, and I think the concerns about what profitability might look like in 3 to 5 years and not just right now.
Well, that's right. The expansion question at the moment is, do you sell a heifer into a record market
Yeah,
price environment, or do you retain that heifer in order to produce a calf crop 3 years from now that you hope still has a profitable price attached to it, right?
that's right. Yeah.
It definitely challenges. Okay, the farm cap side, uh, global crop production has been strong, which has contributed to some of the weakness in prices the last 2 to 3 years. What is the demand driver, or is there a demand driver that offers some potential strength in the coming years?
I would say the big demand driver has been just the domestic market for feed and fuel. There's obviously been lots of discussion about the potential for E15, but even aside from ethanol and biofuels, it's I think just recognizing that once again the U.S. economy has really done very well, and to the extent that consumer spending holds up and drives demand for a variety of things, and business is good at restaurants, again, in general, not everywhere, um, that's going to keep the demand picture strong, and then ultimately prices there too. So I think that it comes back to um, that picture more than anything at a time when there's been a lot of talk about the impact of tariffs, a lot of talk about other countries producing more in the way of crops relative to the US. But in terms of feed demand, in terms of soybean crush and other things that are used in support of transportation fuel, or all different kinds of markets there, that ultimately it's the strength of the domestic market, I think, that has shown a surprising amount of resilience at a time when I think there was a lot of concern about what the potential impact might have been with tariffs.
All right, enough for the outlook questions in a moment. Maybe one more management question to finish the day. And I'll set it up by noting that the reality is, as noted in the question, is the egg economy is under a substantial amount of pressure, whether it's operating costs or whether it's demand or whether it's policy questions and challenges that producers face. Even in our work with risk management and risk management education, for example, there's sort of the reality that in the here and now, producers need to figure out how to manage market risk, but over the longer run, they need to figure out how to adjust or adapt to new price environments. Or in the current year and literally in the next 4 weeks, producers are making crop insurance decisions to manage production risk and maybe planting decisions about the right crop mix. But over the longer run, they're making enterprise choices about which direction to really position their operation. Um, do you know of any analysis, or what have you seen of analysis to sort of give us an idea of what agriculture looks like if the current challenges continue for several years here?
Well, it depends how many years you mean by several.
That's a good question. Well, so
I mean,
maybe that's the first part of the question is
yeah,
we've seen a downturn since 2022, but 2022 was a record.
yeah.
So the downturn has got us back sort of towards long run average.
Yeah,
Is this is this a
I would
more
say we're
realistic average, or is this a downturn?
so I think it's important to remember where we were in 2019, just before the pandemic.
Yeah,
We had been in an environment then, Brad, you remember well, I'm sure, that we were talking about gradual increases in financial stress then, and it had been a
yeah,
5 year environment of a pretty subdued commodity price environment, and cattle was not in a good place in 2016 and
no,
2017. So that was a more concerning time, I think, than where we are right now. Now we've gotten back to that again, but the point that I wanted to make is in 2019, the general expectation was that the next 10 years would probably look something pretty similar to what 2017 to 2019 did, and then the pandemic happened. So I don't think that it would be unrealistic to think that, we could be in a low commodity price environment for the next while, the next several
mhm,
years. Now,
mhm.
that's not to suggest that we'll get rapid declines in land values or any amount of sharp increase in financial stress, but I do think that it's important for operations to look at that with clear eyes and ultimately have the strongest picture possible of what financials look like, not just for this year, but what would things look like if it was 3 to 5 years of that,
Yeah.
and then be trying to work backwards from, what do you do to maintain that amount of viability?
I can point to on the academic side, I know that different research efforts and policy centers have put together some analysis to note if you have model farms that are aggressive, large commercial operations, and they're essentially burning through working capital at the moment, then any sort of analysis that extends the current challenges for 3 to 4 years looks pretty serious to
Yeah,
the overall
yeah.
sector. But as you
Well,
described earlier,
yeah.
it's a difference of farms, the percent of farms that are in that position versus the percent of farms that still have a very strong underlying balance sheet.
Yeah, and Brad, you know this, I know with your policy work, but some of this will also depend on the future of government payments. We've
Yes.
been in an environment for the past 5 to 7 years where there have been ad hoc government payments, whether it was the market facilitation program years ago or the post-pandemic now. Um, and so that will be a major unknown as to whether or not there will be government payments going forward. And if there ever were not government payments, what state would the industry be in to be able to respond to that?
You bet. You bet. Well, Nathan, thank you very much. We've had a great hour of discussion. I'm sure we could continue economic discussion here for quite some time, but we have met our time for our webinar today. I want to thank you very much for joining us and offering your expertise and continued outlook for the ag sector from your role with the Federal Reserve Bank of Kansas City in the Omaha office. And I want to thank everybody that participated today. Thank you for joining us for another webinar from the Center for Ag Profitability. Remember, you can always find webinars on our website. You can find a recording of this webinar later today. You can find past webinars, archived copies, and you can find future scheduled webinars up there as well. As you exit Zoom, you'll see the usual short survey that we have that asks you about today's event and asks you about potential topics you'd like to see us address in the future. We certainly and most definitely value your feedback. We appreciate you as regular participants and sort of stakeholders for the Center for Ag Profitability's effort. And we value your feedback and appreciate you taking a moment to complete that. Finally, thanks again to Nathan and Nate Kauffman for the great presentation today. Thank you for your expertise. Thank you for joining us and offering what you can.
Thanks, Brad.